Welcome back to my series on the inside secrets to angel investing. I'm sharing some of these golden nuggets they're part of a free document you can get for 12 of the inside secrets if you go to inside secrets to angelinvesting.com, inside secrets of angel investing. Yeah. That's the name of the book, Inside Secrets to Angel Investing. It is on the show notes, so you can go there. You can also get it on, well, you can get the real book for $20. Spend that much in coffee a week, right? Anyway, you can go get that, and it's just a wealth of information in the book and on the resource portal that comes with it. So today I'm going to cover Inside Secrets number 7. And this is a juicy one. Let's see. I got one here. Wait, juicy. There it is. Juicy. For those of you that are watching, just got a little flash of a juice. But anyhow, I'm having fun today. So this particular Inside Secrets, and this, all right, let's just do it and I'll unpack it. All right. Ironically, entrepreneurs will often bypass friends and family when raising early capital and go straight to applying to present to angel groups or pitch events because they don't believe their family has funding, or they don't want to feel obligated to a friend or a family if they lose their money. Experienced angel investors will use this as a litmus test. Yes, they will. If the company has received no money, zero, nada, no money from a friend or a family member or someone connected to that friend or family member, it is usually a sign of one of two things. Are you ready? Number 1, friend and family knows something of the character or worth or ethic of that entrepreneur, the work ethic of that entrepreneur that makes them not want to invest or help the company with introduction to potential investors. Number 2, the entrepreneur lacks true commitment and belief in their project to risk family or friends' money, but is willing to risk a stranger's money because they see it as no strings attached. If they truly believe that they would be successful, why wouldn't they want their friends and family to benefit? All right. Is that done? No, let me explain. Because I have to do this to entrepreneurs all the time, because they'll come, particularly when they're really pure startups. It's really, for most of you that are going to get the book and you're going to invest in established companies that are, have millions in revenue, have an operating history, and they're using their growth capital, this will not be that won't be on point that you'll have to deal with. But if you are working with a company that is raising money on Reg CF, Reg crowdfunding, or they come to you as maybe you are the friends and family, or maybe you are the friend of a friend, right? Angel investors call friends and families, those traditional ones, the ones I've talked about, they're in those really exclusive click groups and stuff like that. They call friends and families and fools. And the reason why they do that is because most of the time, a lot of times, friends and families, those are inexperienced investors. They haven't gotten my book. They don't know how to say no. They love what that entrepreneur is doing. They believe in it so much that they're willing to give them some money to get going, but they don't know how to ask all the questions of the things of what they're going to do with it and where they're going to go. I had this company one time that I was working with, and he had raised the friends and family round. But by the time he got to me, he was trying to raise capital. He had a patent awarded. So that's really good. But he'd spent 50 grand on getting that patent. He spent 50 grand of his friends and family money. But there was no way. A patent does not create a company. A patent just says whatever you're doing is unique. And what he was doing was what his vision of what he wanted to do was very unique, and it was really cool. And technically, it would have, done, and I don't want to give up what it was, but technically it would have protected his thing. But the nature of because it was more of the way it was connected in the process of the technology, it wasn't the actual technology, because it was going to be using some existing technology that really didn't function the way he needed it to function for his company to be successful with what he envisioned that he wanted it to do. It was a wearable that would prohibit the activity that he wanted to build into a business. And we worked with it, and I worked with him on pivoting on a way to get revenue, to start, to prove the concept, to wait for the technology that he was going to be using to be able to catch up to what he wanted to do. And it's there now, so he may eventually do that, but he ended up having to really kind of sit back and punt and go into a completely different direction just to make some cash to keep that, and it was unfortunate because he shouldn't have. There's a sequence involved. So, you don't get, you need to test the waters and validate a business before you spend a lot of money on a patent. And that's a whole nother conversation. Go find the one that I did with Dave on that you can search on inventors, and I've got a sequence thing and sequence on business plans and all this stuff. I got all kinds of, I got 240 some odd podcasts out there. I cover every topic. Right now I'm covering inside secrets, the golden nugget. So friends and families don't have to be fools if they do very common sense on it. But the 2 points that I bring up here are separate from all of that of whatever they do with the money, and if they're doing it in the right sequence. It really comes down to, and if you listen to last week's one about Buffett, it's the honesty and the character of the company, of the founders, right? So if the work ethic of that entrepreneur, if he's one of those people that just gets lots of ideas and he's always spinning this stuff and doing all kinds of crazy things, I'm going to do this other thing to make money, going to do this other thing to make money, and he never follows through, that is a character flaw that will limit his ability to build the kind of company that he needs to build in order for you as an investor to get a return on investment. And so there, whatever, there's just something that they know, because the way I explain it to entrepreneurs is that, and this goes into number 2 as well, right? Do you believe, if you really believe that this is going to be wildly successful, the things you're telling the investors, because when investors watch these pitches at pitch events, when they watch these things now on virtual, you can any given week, day of the week, you could be watching a pitch event and seeing deals. Okay. If you really truly believe that it's going to be successful, and all the dog and pony show, I call it a beauty show when they do these 5-minute, 6-minute, 10-minute pitches, because there's no way you can really know whether you're going to invest in that company in that time frame. The best you can do is ask for more information, and that's a whole nother conversation about the process. It's in the book. I got a process in the book. That's called the first date. All right, and so you want to understand that they believe in it. If they really believe that they're going to change the world and make themselves a lot of money, it's like if somebody told you, this is what I tell entrepreneurs when they come to me and they've not raised friends and family and they want me to go find investors for them. I'm like, I can't do that, because here's the reasons why. 1, I don't just find investors, and 2, you have to be investable. And to me, one of the red flags that I do as part of my initial screening for investors is, what have they done to raise money so far to get to where they get? The reason why serious investors will say, well, come back to me when you have a customer, or come back to me when you have your prototype, or come back to me when you've raised X amount of dollars, or come back to me, it's because they don't believe that investor has the ability to accomplish what they say to accomplish, because they are missing some fundamental flaws in the whole scope of it. I just remembered I have another podcast on that topic about the karma, the magic in the air of eventually a broken business is broken. And you can either identify it broken at the beginning, or you identify that it's broken near the end. But eventually they got enough money. Sometimes they'll figure out how they're broken and they'll get fixed. But oftentimes they're just broken. Right. And so that piece of it, of whether they'll put the money at risk, if you have, so here's my story I tell them. If somebody told you, look, there's a bag of gold buried out there on that corner, and all you got to, or in that field or underneath that tree or wherever it is, and all you got to do is go find a buddy with a shovel, because it's going to take 2 shovels to do it. Go find your buddy that's going to help you dig that gold up, and then you can split it with him or give him whatever it is, right? And what would that person do? If he believed that there was gold buried underneath that tree or on that hill or wherever, they would go find their best friend or their mom or their uncle or whoever they love the most in the world. And they would say, hey, come grab your shovel. Let's go dig up this gold, because it's going to be, I know it's there, right? That's what a business plan does. It gives you confidence that you know how you're going to do it. It's checking all the boxes, that you know how you're going to make money, and therefore make money for your investors, right? And so the friends and family becomes the litmus test on that. You know, I have people all the time, they, even when they'll drop the names, oh, I was with this guy, or I know this guy, or I like, particularly if they're in the entertainment space, I know this guy, I know this guy. I go, why don't you go ask them for money? They got all the money. They got the money right there. You know, you just got to ask them. And if you're afraid of asking them, it's because you're trying to get, a shortcut, not do all the work, right? Entrepreneurs sometimes feel like when they go and if they happen to get it, sometimes they can pay a lot of money to be on pitch events. There's a group that I used to work with out in New York, and they charge thousands of dollars to be in their event. And there's a guy that goes around, it's a gathering of, I'm not going to name their names, but the gathering of, right? They operate in Georgia and in Texas and in different places. And the word on the street, your check clears and you can fog a mirror, you can pitch. So that does not mean that they're ready for investment, right? And in entrepreneurs that don't raise money from these organizations, they will often blame the organizations on the pitches. Now, when I ran my angel investor group, we had fees that we had to charge, but we did a lot of work of preparing the companies and preparing their pitch and helping them meet investors. And they had to go through a rigorous screening process. So it was a completely different game. And we had people tell us all the time, you're too tough. You know what I mean? But it's like, that was what it is. I wasn't going to put anything up there in front of my investors that I didn't have confidence, had the ability to succeed, with certain things that I had flagged in our business plan review. When we would review that company for screening, we had a 9-point plan. We would flag it. We would say what they had to do to get money and what they had to do to be successful. And we do that for investors now. And so, individually instead of as a group, or, so that's what it's all about. Right. And that's why it's a litmus test. And you just need to understand that as an investor, as an entrepreneur, if you're listening to this, that's why you have to raise that initial round and get through all those things. You can go back to friends and family. Another place you go back to friends and family. If you are a business that has raised $3 or $4 or $5 million, and you're doing that kind of revenue, and you don't necessarily have the cash flow to take out $20,000 a month to pay that lawyer, or $15,000 to get your books audited, or whatever else you've got to do to get ready to raise capital from direct public offering. And you need to go get money from investors to be like a convertible note or bridge financing to do this. You've got to be able to, same sort of thing. You've got to have confidence that you're going to be able to do it and succeed at it. And you've got to have all of the pieces and parts that says that how you're going to go from 10 widgets a week to 100 widgets a week if you're going to scale at that level that you're raising the capital, so that they feel comfortable that they're going to get their money back. And all of that, whenever you get that, it's just whenever you get a pushback from an investor, that's a lot of times what it is. And they're deflecting because you haven't done your homework, Mr. Entrepreneur that's listening, Mrs. Entrepreneur, Ms. Entrepreneur. For an investor, that's one of those aha things, like, I know of the 100 some odd investors I interviewed, and they said, what would I never do? You know, how did you first learn how to be an angel investor? Reason why I wrote the book, right? Part of the reason why I wrote the book was so that people would have a step-by-step guide. It even says it, step-by-step strategies, right? They would have a step-by-step guide of what they need to do. And the reason why I put these little gold nuggets of these inside secrets, the 44 of them, that's in the book, was because there's things that, you know, you just really needed to draw attention to. And this was one that I saw all the time. The investors told me that, well, they got started investing because a friend invited them to a meeting, and they went to a meeting and they saw this company and they loved it. They loved the entrepreneur and they just decided to invest, and they didn't know. And one of the things that they figured out was that they had to have raised some money or have a lot of their own skin in the game. The exception to that rule is if they put 100 grand of their own money into it, or more, or something like that, they really leverage themselves. But they still should, because it also is a test of their confidence to be able to raise the capital, which is a big topic I talk about in the book. Because if a company can't raise the capital all the way through the process, then they're not going to get all the money. That's why they get stuck. That's why you have angel groups that will have companies out of their portfolio. A third of them will be ones that are just sort of stuck. They're making money. They're just not making a lot of money. They're not growing at a pace that will trigger an exit that's going to give those investors their internal rate of return, because they didn't know how to raise all the money. They could sell angel investors on it, but they didn't know how to go raise the next round of capital that they needed. And that particular group of angel investors didn't have the connections with the venture capital to be able to connect them up to the next round of finance that they were going to need to be able to become that 20 or $30 million company, or that $50 million company, or that $100 million company. It takes all those different rounds of capital. So that's it. That's number 7 out of 44. This is my third of this series. Thank you for tuning in and watching or listening. Please comment if you like this. Give me a 5-star, and tune in the next time. Thank you so much. Join the Compassionate Capitalist Movement and get this book. It's the best thing you can do to give your money an upgrade. And with that, onwards and upwards.